my presentation today is bullish crude oil fundamentals, bearish natural gas fundamentals, but more importantly, a focused on realized pricing. So the main message is forget oil prices. So when you see somebody on TV or talk with an analyst prognosticating about oil prices, it doesn't really matter. What really matters for individual companies, and especially for US production, is price realizations, or what they're actually receiving per barrel. To drive that point home, 2018 looks like it's shaping up to be a very good year for the energy sector. And you can make plenty of beer money focusing on crude prices, but if you're like Keith and you like a fine glass of wine, focus on price realizations. So my clients know I love a good matrix, and even better if my 4-year-old can help me color it in. So what this shows is across the top row are varying WTI crude oil prices from 30 to 100, and vertically are varying natural gas prices from $1.25 all the way up to $5. And the dark box you see with $28.32 in it is what the average US E&P gets per BOE, per barrel produced, in a $50 crude and $3 natural gas environment. And if that seems painfully low, when you look through the financial statements and company reports, we verify that bottoms up and top down, and you can see that 32% of production from US E&Ps is actually sold as crude oil. The rest is natural gas and liquids and condensates and other substreams. So if you look back at why, this explains a lot about why E&P share prices performed so poorly earlier this year. In Q2 2016 at the cycle low, with $48 WTI and $2.24 natural gas, E&Ps were getting about $23.90 per barrel. And what those fancy colors mean in the upper left, when we get in the red boxes, that's below $20 a barrel or BOE for price realizations, and that's where E&Ps cancel rigs, they stop contracts in the middle of it, they pay termination fees, CEOs wish they become doctors, that's complete washout. In the orange zone, the rig count's declining, times are bad, but you hear lots of talk, oh, it'll be better, or we're lean and mean, or we're doing our best wells. The yellow zone's a little bit of a gray area, so the rig count's typically declining, and we've kind of been in and out of that yellow to green zone this year. But once you make it into the green, over $25 per BOE, most US producers are making money and they're able to drill and maintain or grow the rig count. So going back in Q2 2016, we got into that yellow and even into the orange. We were at $23.90 per BOE. Rig count was falling. Costs, when you add up, bottoms up costs from financial statements of all the companies, which we do. Production margins, production costs were $17.16 a barrel, so margins were about $6.70. Earlier this year, with what looked like a pretty nice recovery, with WTI up to 50 now and $3 natural gas prices, the average E&P is getting about that $28.32, $28, $29 realization. Costs have come up a bit, though. It looks like they're going to shape out to be about $20 a BOE in Q3. As a result, production margins aren't much better than they were in Q2 16, and you definitely see that in cash flows. In most cases, free cash flow is a bit better because they're spending less on CapEx. In a lot of cases, it's not. They're spending more. It matters also for share prices. So this shows the orange line is a daily graph of the average US E&P price realization. The white line is we use the XOP ETF just to represent US producers and just take it times 0.7. So rather than adjusting the scaling to make a perfect fit like a lot of technicians do, we just multiply it by 0.7. And you can see a couple things. Not only do the charts follow very closely, since this goes back to 2012, but we had an unusually wide discount as we came into the spring and summer. E&P shares were trading less expensively than they should have, in our view, for the given oil and gas prices. And you could see that in the sentiment. Nobody admitted to owning energy stocks. Generalists avoid the sector like the plague. And we're starting to see, with that vertical line on the white line, E&P share prices recovering. We're starting to see the opposite. So getting into crude oil fundamentals and what's getting investors excited currently, this shows on the top box the December 2016 demand forecast from the IEA, for global crude oil demand. Below is September 2017, their most recent update. And so overall, you can see in the bright red star, they're now forecasting 1.6 million barrels a day of increased crude demand in 2017. The key swing, though, if you look from their December 16 report to the most recent one, Q2 demand was revised up 800,000 barrels a day, probably one of the biggest revisions on record, and Q4 is up 500,000 a day. Q3 is a little bit messy with Hurricane Harvey and supply demand, so we kind of write that one off, and they're holding it basically flat. But overall, we've had a meaningfully improving crude oil demand market as we worked our way through 2017. The main reason why, if you look at OECD indicators, so leading economic indicators, are pretty much positive all around the world. Nothing blow off. We're not at excessive levels, but generally Chinese growth has been, GDP growth has been better than expected. U.S., including profit growth, is better than expected. Europe, Soviet Union, pretty much around the world, there's a very nice but controlled growth cycle. Looking at the supply side of the equation, the EIA is expecting non-OPEC supply to grow by 0.78 million barrels a day this year. So net of their 1.6 million demand growth estimate, looking for a good 800,000 barrel a day tightening in what was maybe a 1.2 or maybe 1.5 million barrel a day oversupply at the start of the year. The numbers, however, show a couple things. The U.S. market is expected to grow production 630,000, so virtually all of the global increase. In the first half of the year, production was only up 94,000 barrels a day. We've had some very weak production data coming through the summer. Currently, based on the weekly estimates, which have overstated monthly productions in recent weeks, they're showing 499, 500,000 barrels a day more production than last year. That's probably too high. Even if we were to average, say, 800,000 a day more production in the second half, in addition to the 100 in the first, you're still looking at, say, a 450,000 barrel a day growth number, while they're estimating, 650 nearly. So not surprisingly, U.S. inventories and OECD inventories have been shrinking. The chart on the left shows crude stocks for developed countries, non-U.S. They have come down not only below 2016 levels, but below 2015. The chart on the right shows, product, so oil, diesel, distillate, or I should say gasoline, diesel, distillate. They've been coming down, they're not quite down to previous year levels, but they've gone a long ways from the very top of that channel toward the middle. In the U.S., I like to produce this chart combined, so we show crude and product inventories to take away swings in refining utilization. And prior to Harvey, we saw the same thing where we were getting well below last year's levels and kind of approaching 2015 inventory levels. Switching to natural gas bulls love this chart. And so this shows the natural gas rig count in the U.S. has gone from nearly 1,600 in late 2008 to 189. So clearly, it's a very bullish chart. A little bit of sarcasm. If you rebase it to the percentage change year over year, the rig count's actually up 108% year over year. That's in any modern data, we've never seen an increase that high. And what's interesting, like even in 2014, if you look at 13-14 on the chart, and we'll highlight that period later, the rig count actually never even went positive, and yet that was one of the strongest production growth periods in modern history as well. And so it comes down to rig productivity. This chart shows the bars are basically that same rig count. We use full year averages here, so it doesn't quite get to 1,600. But you can see, back to 2007-8, where you were over 1,400. The blue line is how much natural gas came from the average new well. And so rig productivity, gas per rig, increased 28% from 2008 to 14, and then it surged 52% in 15 and 71% in 16. Part of the increase in 15 and 16 was due to focusing on the very best wells and kind of moving back on the fairway, if you will. But most of it was actually technological improvements. And so what that means, as the rig counts declined from 1,600 to 189, natural gas production's actually gone from 55 BCF a day to over 74, an all-time high. So talking about that 2014 period where the natural gas rig count actually never did go positive year over year, what kicked off the surge in drilling, again, even though rigs didn't go positive, was the very cold winter. If you remember the 13-14 winter, we had deliverability issues in the Midwest, and people paying $10 for gas, and ethanol plants were actually shutting down because it was more positive to sell their natural gas futures. It was more profitable than to actually run the plant and make ethanol. So gas briefly got above $6 an MMBTU. In response, the white line shows natural gas production. We added almost 7 BCF a day over about 10 months. And as a result, if you look at the resulting hangover on the red line, natural gas prices went from kind of mid-4s to 5s, all the way down to 2 by 2015. But it basically gave us a 2-year hangover until demand could digest that supply. And even then, it wasn't until production turned down again in 15 that prices recovered. So if you fast forward to the far right end of the chart, today's production response is actually more swift than that. We model that by December or perhaps January, it'll be a greater total production response. So we'll have more than 7 BCF a day as production response. It'll also be a greater year-over-year increase in production. And yet the red line hasn't really reacted. And you did see that somewhat in 2014. If you look earlier in the year, white line's coming up, production responding, the gas price kind of fizzles around, and then, just like oil and the Thanksgiving massacre, there's just one day where market participants realize, oh wait, this supply and demand are out of whack, and the price gets crushed. And I think that's what's coming for natural gas. The EIA gives us these great little drilling productivity reports. A lot of analysts look at it for productivity insights and regional rig balances. I look at it for production growth guidance. And so they actually do give you their best estimate of production from these regions, which total 58 BCF a day roughly. And they've been showing 0.8 to 1.1 BCF a day of production growth each month, based on the current rig count. We also do bottoms-up work on U.S. E&Ps. So when you add up the production reported by E&Ps in Q2, which is just over 17 BCF a day, and kind of index that to U.S. production, you can see that analyst forecasts, which are roughly in line with their guidance, bring total production over 73 BCF a day in Q3, and kind of right on track. Weekly data showing us in the mid-74s. And then on their numbers, by over 79 BCF a day, which would be plus 8.5 BCF a day year over year in Q1. We think that actually happens November or December, but even the companies are telling you in aggregate the production response is on the way. So Range Resources, they haven't updated this in several months, but they show by component how their production costs have changed from 2011 through 16. In 2011, they were a low $4 producer. In 2016, they were a $2.58 producer. But as you can see, the majority of that, the bottom row on the table, is actually transportation. Transportation, the majority of U.S. natural gas producers are below $2 production costs. And as we know, when you get into a down cycle, prices tend to generally decline below production costs to incentivize rigs to be laid off and to finally get supply and demand to come back into balance. So one of the counter arguments is, demand. That's supply numbers are great, Nathan, but you're ignoring the demand, because there's clearly LNG exports, there's exports to Mexico. When you look at exports to Mexico this year, they've been roughly flat in recent months. They're up a few tenths here and there. And analysts have generally modeled pipeline exports would be up over a BCF a day. What's happened is Cheniere is actually sending LNG out to Mexico. So the chart on the right shows the number of cargoes. I think there's 172 cargoes represented on that chart. Nearly 40 of them have gone to Mexico. And in June and July, the latest data we had as we made the slideshow, 11 of 27 cargoes leaving Cheniere actually went to Mexico. So when analysts are calculating their demand estimates, they're including a BCF a day of increased imports in Mexico, 1 or 1.5 BCF a day out of Cheniere, not realizing that the one out of Cheniere is going into Mexico. So there's been a bit of double counting on the demand side. And this chart just quickly shows inventories have come a long ways from being 429 BCF below last year levels at the end of March to just 134 now. A good part of that is weather, to be fair. So we calculate 171 of the catch-up is weather. But 124 is due to supply demand. So despite increased LNG exports and very low supply growth over the summer, so we calculate from March through August, U.S. natural gas production was actually only up 0.52 BCF a day from the prior year because we started off in the March, April, May period with production below prior year levels. We're now running just over 3 BCF a day above prior year, and as I mentioned, by kind of December, January, we could be +8. So conclusions, we'll go back to the matrix. I think try to make this one that you can print out and hang on your wall. So when you look at the different scenarios for 2018 and what our gas thesis really means for oil prices, the tables down below shows at $3.50 Henry Hub and $45 gas, U.S. E&Ps can get about $28.70 a BOE, which is decent times. That's enough for the rig count to be supported or even increase and production to grow. You get slightly lower revenue at $3 Henry Hub and 50 WTI. If you go all the way down to $2 Henry Hub, which I do think is in our future for 2018, that won't be the full year average, but I think we'll spend several months down there. You could have $60 WTI and lower price realizations than you do today. And I think that's a key distinction. Very often you see analysts, especially on TV or in the media and Barron's, talking about their $60 oil price forecast and how that's going to create a massive supply response, but very rarely do they mention what natural gas price they incorporate into their views. In terms of company level, a lot of the companies here today are actually quite oily in nature. So the more of your output and the more you focus on the realizations of the companies you're looking at, the better they'll do in this environment. If you're a pure oil producer, you're going to see your pricing go from $50 to $60 a BOE. Despite Permian and U.S. producers actually seeing declining realizations. The other thing that we tell clients frequently is you don't necessarily have to take what a company gives you. So if you have a favorite company, whether it's Diamondback or pick a Permian producer, Resolute, even Lillis to some degree, if you look in their financial statements and see their natural gas exposure, you can either buy a short ETF or short a gas producer, or the UNG is a wonderfully flawed ETF. It represents the gas price, but it underperforms by about 35% per year. You can effectively short out the gas exposure of any E&P and create a synthetic oil company. With Keith's conversation service, we actually provide a full 35-page, twice-a-year, 5-year outlook on the natural gas market. And I can say the one that we did in May, and we're coming up for the refresh, is probably the most bearish long-term fundamentals I've ever seen. So I think this concept, the idea of shorting out and neutralizing gas exposure from otherwise good and efficient companies is going to be one of the most interesting themes for the next 2 to 3 years. With that, I'll give it back to you.
Awesome. Thank you.
Thank you.